What I have for you today are two very interesting cases from the local court of Breda in Holland, and you can see the artist's impression of the courthouse here, which I think is quite a nice building. But let's dive into the cases. You can see the cases are from May and December 2023, and it deals with something called interest on net equity payments. And let's see what that is. Imagine you have a Brazilian subsidiary and a Dutch parent, and then you can make payments from the Brazilian subsidiary to the Dutch parent, and these are interest payments on your net equity, which means they are deductible for the Brazilian subsidiary, but you can only make them if you have positive net equity. And that's the first concept to understand here. The second one is there are tax-bearing credits involved, in the sense that the Brazilian-Dutch tax treaty says that even though Brazil can only levy 15% withholding tax on dividends and interest, Holland will give a tax-bearing credit. So in other words, it will credit 20% of taxes on interest, and it will credit 25% on dividends. Right, so tax-bearing credit, the source country levies lower withholding tax on outgoing payments than the recipient country gives credit for. And this is very often a thing that you see between developing and developed countries, where the developed country says, you know, rather than taxing whatever you don't tax, we will actually deem you to have taxed something, and we will give you a credit for that, and not take the money when you try to incentivize investment by lowering your withholding taxes. We will look at the Vienna Convention on Law of Treaties, which is a treaty codified in the customary international law on tax treaties and other treaties. We will look at general rules on treaty interpretation, BEPS Action 2, which deals with anti-abuse rules for hybrid structures. And you can already feel here you've got a payment which you make on share capital on your net equity, but it is deductible. So you're in the sphere of the hybrids. But we will not look at the MLI, which dealt with this BEPS Action 2, because Brazil has not signed or ratified the multilateral instrument at the time of recording this video and this court decision. So let's look at all of this in numbers so we understand all of it a bit better. Imagine Brazil has an EBT of 1,000. It doesn't make any interest on net equity payment, and therefore its EBT is 1,000. It then pays 25% Brazilian corporate tax, and I know the Brazilian corporate tax is more complex. It's got a 15% base tax and 10% on top, and then there's Social Security, but we'll keep it for 25% just for this numerical example to keep things simple. So after tax, it has 750 that it can distribute to each Dutch parent. There is a 15% withholding tax on that dividend, so that's 112. The Dutch company is deemed to earn a gross dividend of 750. And there's no corporate tax because there's a Dutch participation exemption on that. There's also no credit for the Brazilian withholding tax. So the total cash tax on this 1,000 earnings before tax is 362.5, 250 Brazilian corporate income tax and 112 Brazilian withholding tax on dividends. Now, if there was to be an interest on net equity payment made from Brazil to the Dutch parent, then the Brazilian EBT would be 0. The Brazilian corporate tax would be 0. We will assume that you can make a payment this large, but there will be a 15% withholding tax on the interest on net equity payment, so there'll be 150 tax in Brazil that way. The Dutch earnings before tax will be 1,000. The Dutch corporate tax will be 250, but you'll get a credit for the Brazilian withholding tax of 150. And then there's this tax-bearing credit that says that interest, the tax bearing is not only 15% that you paid on withholding tax, but it will be deemed that you pay 20. So then you get another 50 in credit, and you only need to pay 50, so that your total cash tax now is 150 that you paid in Brazil and 50 in Dutch corporate income tax left after tax credits, so it's 200. However, if you were to treat the interest on net equity as a dividend under the treaty, then in Brazil you'll still pay 0 tax because the interest on net equity is a deductible payment. You will still pay the 150 withholding tax, But in Netherlands, you will now get still an income of 1,000, not because you treat this as interest income, but because Holland has implemented BEPS Action 2, saying that if a dividend is deductible, you will not get an exemption for the dividend income. So your taxable income will be 1,000. You will pay 250 Dutch tax. That will at least be what's due initially. You'll get 150 credit for the real withholding tax withheld. And then you will get, because if you deem this to be a dividend, not interest, you will get a 25% tax bearing credit. So you'll also get another 100 on top. You'll pay 0 in tax, and your total cash tax in this scenario will be 150, being only the 15% Brazilian withholding tax. So these cases are about fighting about whether the total cash tax should be 200 or whether it should be 150. And if we look at the timeline of these cases, the payments of interest on net equity were made between September 18 and August 19. You had a decree in the Netherlands in August 2020 in which it said that we will treat the interest on net equity as interest for tax treaty purposes, so you only get a taxpayer credit of 20%. This was confirmed in a Article 25.3 MAP procedure in 2021, and the MAP procedure was again published as a separate decree in April 2022. Now, if we look at the treaty itself very quickly, Article 10 dividends, 1 says that the source resident country can tax, and then 2 says, but if the recipient is the beneficial owner of the dividends, the tax so charged in the source country shall not exceed 15% of the gross amount. And then they define dividends as income from other rights, because what is this net equity on interest, right? Not being debt claims. Now this is net equity, it's not a debt claim. Participating in profits, it does, because you can only pay it when there is a profit, as well as income from other corporate rights which is subjected to the same taxation treatment as income from shares by the laws of the state of which the company making the payment is a resident. Now here's the problem, because under Brazilian law we said that this interest on net equity is deductible, which to me doesn't sound like it's the same treatment as income from shares. And we'll get back to that. And then Article 11 on interest says, paragraph 1, resident country can tax, and then paragraph 2 says, source country can tax, but if the recipient is the beneficial owner of the interest, the tax surcharge shall not exceed 10% in case of banks, but 15% of the gross amount of interest in all other cases. So again, whether it's dividends or whether it's interest, the treaty allows Brazil a withholding tax of 15%, and then interest is defined as income from debt claims of every kind, as well as other income assimilated to income from money lent by taxation law of the contracting state in which the income arises. So again, the payor state. Now you get the feeling here that, I mean, you could argue that this interest on net equity could be either a 10.3 or it could be 11.4, and it's not 100% clear. Now, if we look at what the Brazilian treaty says on elimination of double taxation, it says Netherlands shall allow deduction. So it will give a credit for source taxes, right? But then 23.4 says the tax paid in Brazil shall be deemed to be, for purposes of Article 3, with respect to dividends, 25%, right? And with respect to interest, only 20%. So this is your tax-bearing credit paragraph in Article 23. And then the mutual agreement procedure under 25 says that the competent authorities of the contracting state shall endeavour to resolve by mutual agreement any difficulties or doubts arising as to the interpretation or application of the convention, including Article 9. And this is exactly what they've done. They said, you know what, how do we treat this net income or interest on net equity for tax treaty purposes? Does it fall under Article 10 or under 11? And they've agreed that it would fall under Article 10 as a dividend. If we look at Article 3, that's also important to look at. Paragraph 2 says, as regard the application of the convention by contracting state, any term not defined therein, such as how do we treat interest on net equity, unless the context otherwise requires, have the meaning which it has under the laws of the state concerning the taxes to which the convention applies. So since this is an interest withholding tax or dividend withholding tax, it's a law applied by Brazil. We need to follow the Brazilian qualification, and as we saw in the second slide, that was deemed to be interest, not dividends, right? And then there's an interesting part in the OECD Model Convention. The treaty also says all the competent authorities agree to a different meaning pursuant to the provisions of Article 25. So this refers to a 25.3 treaty, which says, if the term is not defined in the treaty and it is not defined by the competent authorities, then you can go and look at the national law of the source state. But this red striped out text is not in the Dutch Brazilian treaty. Nonetheless, Article 3.2 remains relevant because it predates the mutual agreement procedure, and that is important, as we'll see in a moment. Okay, if we look at the Vienna Convention on Law of Treaties and we look at the interpretation, Article 31, which gives us the primary means of interpretation, says a treaty shall be interpreted in good faith in accordance with the ordinary meaning to be given to the terms of the treaty in their context and in light of its object and purpose. And then in the context means the preamble, the annexes, and then any agreement made in connection with the conclusion of the treaty. Now that's not what we've had because it came after the conclusion of the treaty. Any instrument that was made in connection with the conclusion of the treaty, again, that doesn't apply. But then we get to paragraph 3 and it says that should be taken into account together with the context any subsequent agreement between parties regarding the interpretation of the treaty or the application of its provisions. So this is squarely Article 25.3, right? So this is still a primary means of interpretation, and there's a letter B and a letter C. And then finally, paragraph 4 says a special meaning shall be given to a term if it is established that parties so intended. And it's very clear that parties have intended to give a special meaning to the term interest in this particular case for interest on net equity. The Dutch court refers to the Vienna Convention on Law of Treaties. It says the court states first and foremost that the Vienna Convention on Law of Treaties does not apply to the Dutch-Belgium Treaty, given the date of Brazil's accession to this interpretation treaty. So what it means is that Brazil acceded to the treaty after it already signed the treaty with the Netherlands, and the Vienna Convention on Law of Treaties very clearly says that it does not apply to treaties signed before you've acceded to the treaty. Nonetheless, the court correctly says that this does not mean that the rules of the Vienna Convention does not apply, because the Vienna Convention is simply a codification of customary international law, and customary international law applies regardless of whether you accede to the Vienna Convention on the Law of Treaties or not. Now, if we look at the 25.3 map on the interest on net equity, what the competent authorities agreed is as follows. The competent authorities of Brazil and Netherlands reached the following mutual agreement. This competent authority agreement is entered under Article 25.3. So what we've just looked at is relevant. After discussing the issue, the competent authorities considered the following elements should be taken into consideration for the qualification of the JCP. And the JCP is just the Brazilian words or text for the interest on net equity. First, JCP is treated as interest for Brazilian tax purposes, meaning that JCP is deductible for the taxpayer and taxable for the payee. That is indeed how interest works. Second, Article 10.3 and 11.4 reads as follows. We've already looked at that. And then they come to a conclusion saying in specific cases, the convention indicates that the qualification should follow the taxation treatment of the residence country of the company making the distribution of the dividends or the residence country of the payor of the interest. And they come to the conclusion, the competent authorities have agreed that the JCP is considered interest within the meaning of paragraph 4 of Article 11. So very clearly only a 20% tax-bearing credit, not 25%. And then it just gives the date of when this treaty was signed. And now if we look a little closer to this last sentence or second last sentence, the competent authorities have agreed for the purpose of applying the convention in accordance with Brazilian law, JCP is considered interest within the meaning of paragraph 4 of Article 11 of the convention. Now, we've already looked at the treaty and what it says. We've also looked at 3.2 and what it says. And then the Dutch local court says the tax inspector attaches decisive importance to the decision and the map agreement. In the context, the court considers that the lack of clarity of the tax treaty text should be at the expense and risk of the contracting states, not the taxpayer, and in case of reasonable doubt should not be interpreted to the detriment of the taxpayer. Since the uncertainty about the qualification of the IONE as a dividend or interest still existed in 2018, the court believes that the treaty's ex post interpretation through MAP in 2022 cannot be invoked to the detriment of the taxpayer. So this is where the chronology is important, right? The IONE payments were made in 1819, as we saw. We had this MAP, we had the decree in 20, then we had the MAP in 2022. And what the court says is, yeah, sorry, you can't give that retroactive effect. But now what is interesting is, why did the court not look at Article 3.2? We've seen that the treaty has an Article 3.2. Article 3.2 says any term not defined in a treaty will have the meaning that it has under the national law of the source state, or the state applying the treaty. And that very clearly says that you should treat this as interest, not as a dividend. So I think that's one of the criticisms of the court. You should have treated this as interest if you followed Article 3.2. However, let's see what Article 25.3 of the OECD commentary says, because it changes things a bit. Paragraph 3 to the commentary says the first sentence, paragraph 52, paragraph 3 of the treaty says the first sentence of this paragraph invites and authorizes competent authorities to resolve, if possible, difficulties of interpretation by means of mutual agreement. But then it goes on to say in 53, it is important not to lose sight of the fact that depending on domestic law of the contract state, other authorities, like courts, like our case, have the right to interpret international treaties as well as the competent authority, right? So the court can interpret the treaty as well, except the court, of course, has to do this in line with the Vienna Convention and the OECD commentaries. And then the commentary to Article 25.3 also says mutual agreements resolving general difficulties of interpretation are binding on the administrations as long as the competent authorities do not agree to modify or rescind the mutual agreement. And this is important because it says here that the 25.3 map is binding on the administration. It doesn't say that it is binding on the taxpayer, and we'll get back to this later. I first want to look at the Dutch 2020 decree on interest on net equity, and it said, for Dutch tax purposes, the interest on net equity is regarded as a benefit from share ownership, right? So very clearly it puts you under Article 10, I would argue. However, the Dutch government then goes on to say, to determine the amount of taxpayer credit for the interest on net equity, it is important whether the interest on net equity qualifies as a dividend or as interest. And the determining factor is the way in which the source country treats the income for tax purposes. In Brazil, the interest on net equity is treated as interest. So for the application of the treaty, this qualification is adhered to. The interest on net equity therefore qualifies as interest for the purpose of the tax treaty. That means that the tax treaty, that under the tax treaty, the interest on net equity is entitled to a taxpayer credit of 20% for interest and not 25% for dividends. But then the decree goes on to say that it enters into force. This decision shall enter into force on the day following the date of issuance of the government gazette in which it is published. And this decree brings up a number of questions, right? First, if the 2020 decree did not claim a retroactive effect, as we can see here under point 3, why did the tax authorities do so under the map? Why was the decree published before the map, and was the map intended to fix the decree? These are just questions that come to mind. It's almost as though the Dutch did not have confidence in their decree only, and then they asked Brazil to back them up, which Brazil, to be fair, could do very easily, because there was no skin in the game for Brazil, right? They were not going to get more or less revenue based on whether they entered into the map or not. 2, if there was no 25.3 map and the taxpayers went to map, the competent authority could have reached the same conclusion as in the 25.3 map, right? Now imagine that the taxpayer filed a return, claimed 25% tax-bearing credit, and the tax inspector said, no, this is interest, you can only get a 20% tax-bearing credit, and there was no 25-3 map here. The taxpayer said, okay, well, then we're going to go to map about this, and Brazil, even though it's got no interest, accepted the map request, and then Holland and Brazil sat down together and ultimately decided, like they've done in this map from 2021, that that for treaty purposes, the interest on net equity payment should indeed be treated as interest, not as dividends. If that was the case, it was up for the taxpayer under Article 25(2) to accept or reject this map agreement. And the taxpayer could have said, sorry, I do not agree with you. I'm going to go to court, right? So the taxpayer having the right to reject the mutual agreement procedure agreement under 25(2), why would it not have the same right under 25(3)? There's from that point of view, it is logical that the taxpayer is allowed to reject the 25(3) map because he can do it under 25(2). On the other hand, it will be an administrative nightmare if every interpretive mutual agreement procedure that is concluded under 25(3) is still subject to taxpayers rejecting it and taking it to court. So this is what makes this case interesting, right? The procedures in 25(2) and 25(3) do not work very well, and as we saw in the commentary to 25(3), the OECD guideline says nothing, or commentary says nothing about whether a 25(3) map has retroactive effect or not. I mean, the usual OECD blurb would be, if it is only interpretative, then it should have it does not have retroactive effect. It's just clarifying how things have always been. But that text is not in the commentary to help the taxpayer or the tax authorities in this case. And then there is one last point to make, and that is, how does this relate to countries' duties under BEPS Action 2, and why does the Netherlands government take two opposite positions vis-a-vis national law and the treaty? And remember, BEPS Action 2 was meant to fight hybrids, right? So you would assume that both the Dutch laws and the way they get interpreted, and the treaties and the way they get interpreted, would push the courts to not facilitate hybrid treatments, right? And why did the court not look at BEPS Action 2 here? It already agreed that this dividend was going to be taxable because it was deductible. That comes from BEPS Action 2, even though it is incorporated into Dutch law under Article 13, paragraph 17, as you can see here in the top paragraph here above under 2 qualification of IO and E. But the Dutch government didn't help itself either, right? Why did it in the 2020 mutual agreement, not mutual agreement, but decree before the mutual agreement procedure, why did it say there both that for Dutch tax purposes this payment will be treated as a dividend, but then went on to say, but for the treaty and for Brazilian tax purposes, this is interest. I mean, you generating in a post-BEPS era, you generating another hybrid, which does not seem to be a very good idea. That is what I wanted to discuss with you about this case. I think it brings up a lot of interesting questions. I think it will definitely be appealed, and I look forward to discuss the appeal decision when it has been made. The taxpayer actually asked for this case to be taken straight to the Dutch Supreme Court, but the Dutch local courts have denied that. So we'll have a Dutch intermediate decision before we maybe go to the Supreme Court. Bye for now.